Hi, good afternoon. Welcome to the Marketplace. Coming up, Associate Professor of Finance at the Andrews University in the U.S., Williams Kwesi Pepa warns that Ghana risks crowding out the private sector in 2026 if domestic borrowing surges. He'll join us with his perspective on the 2026 budget. Also coming up, investors continue to ditch the Treasury market despite the Finance Minister, Dr. Kansler Tuforsen, unveiling the 2026 budget. We'll find out why. Plus, global market pressures expected to trigger marginal increase in fuel prices. My name is Darryl Kwao. Details coming up. Thanks for staying with us, everyone. Now, Associate Professor of Finance at the Andrews University in the U.S., Williams Kwesi Pepa, has warned that Ghana risks crowding out the private sector in 2026 if domestic borrowing surges. While the 2026 budget promises stability and ambitious investments, he says rising debt interest payments could slow growth and job creation, posing a serious challenge to government's economic transformation plans. Professor Pepa joins us on Zoom with his perspective on the 2026 budget. Good afternoon to you. You've warned about the potential crowding out effect. Can you explain what that means for Ghana's private sector and everyday business?
Good afternoon to you, Darryl, and I hope you are doing very well. So if we listen carefully to the finance minister and if you have gone through the budget, he has indicated that 2026 Ghana is going to finance all its cash deficit of about 71.9 billion Ghana cedis from the domestic market. He detailed in Appendix 3A that he's going to raise about 38.3 billion Ghana cedis from commercial banks. And then from non-banks, he's going to source from them about 33.4 billion Ghana cedis. What this means is that so between 2024, 2020, and as at 2025 August, banks' loan portfolio that they've given to oil industries and other entities in government stood around 95 billion Ghana cedis. So if the government is going to require 71.9 billion Ghana cedis, which is about 75% of the total loan portfolios that will be raised by will be needed. Banks will be providing and other financial entities. It means that government is going to mop up all funds in the systems, and it's going to be very difficult for private entities or companies to be able to get source of funds. So this is a major challenge that's something going to happen in 2026. Even though government intends to create jobs, you see that this approach normally when we see it happen, we normally see that then government becomes the engine of growth instead of private sector becoming the engine of growth. The other side of effects are that we normally know that governments are not to be more efficient, and we see a little bit most of corrupt activities. And when government is the engine of growth, that is why we prefer to see the private sector leading the engine of growth. So government crowding out or taking most of the money that will be available for loanable funds available in 2026 is really going to affect private sector to be able to innovate and then also create the employment creation that government is looking out for. So 2026 The budget looks good, point of stability. However, the challenge is that the government is going to mop up all funds within the economy.
And the budget aims for a primary surplus, but interest rates still leave a significant fiscal gap. How big of a challenge is it for government's finances?
I mean, this is well known when we went to IMF in the document, so that's why we had a plan to be able to go through it. So simply put, I'm going to explain it very simply for us to understand. When the finance minister focuses on primary surplus, meaning that he's going to make sure that to cover for government expenses, he's going to use his own revenue. And he's going to be able to ensure that you have a positive figure, which we'd call a surplus of 1.5 of GDP. But then when we start including the payment of interest, government will go into deficit, which is the challenge. The real test is how we manage the deficit. Normally we see that the primary balance is only to check government effectiveness, how effective they are able to use the resources. So in normal accounting, we call it the operating income, which is what in the economics they call it the primary balance. So government is being effective by giving 1.5, but when we bring in the payment of interest, we move into deficit, which shows that at the end of the day, there is huge gap, and whatever strategy the minister has put in place, he must be very careful how he manages his cash flow. That is why when you look at the budget, they use two terms: commitment basis and then cash basis. So he's telling us that commitment basis, he's going to make sure that he reduces the deficit to 2.2%. But when it comes to cash basis, it's going to go to 4.4% of GDP, meaning he will need more funds to be able to survive, which is the financial challenge that we are going to face in 2026. So what this tells us is that if government fails on revenue collection, his plan will not work. It is he's riding on a very thin line. Any deviation from revenue collection means that he may have to slow down on most of the capex that he has laid out in his plan. That's why I mentioned some of the capex needs to be addressed.
Well, the government has started its big push infrastructure program, is planning investments in agriculture, infrastructure, education, health. How can the government balance these priorities without stifling the public sector?
I mean, it's going to be very difficult. So if you technically look at the budget, the 71.9 billion that the government is going to raise, he's going to use 30 billion of that to support the big push agenda. So he's going to really struggle. The primary balance tells us that yes, revenues are going to be used to pay for government daily expenses. However, for capital expenditure, he must borrow. That is why he talked about the infrastructural bonds and those things. It is going to be very, very difficult. Why do I say it's going to be very difficult? We all know why now people are afraid to invest in bonds because of what happened, the DDP. So if I were the minister, I would start asking the Security and Exchange Commission to come out with education to just educate the general public on how to still come back to the bonds market to invest and the benefits, so that you'll be able to get that 30 billion he wants for infrastructure and other projects. If he's not able to raise that money, the health sector will be affected, education sector will be affected. Most of the plans he's laid down for will not be achieved.
What are your recommendations to ensure that domestic borrowing does not push up interest rates and also limit access to credit for businesses?
So the first thing, we may need to find a way how to get new capitals coming in from the banks. So the banks must be, and I'm sure the Bank of Ghana very soon will be coming up with some discussion on their capitalization, because if new capitals are not able to come in, government will not be able to get the money, because government, if you look at it, they cannot go to central bank for loan. They are going to rely on commercial banks. Commercial banks' capital are already tied up. So, meaning he must have some discussion on commercial banks. Then the other point will be like looking at the investment strategy for pension funds and authority. The formula must be looked at, where about 10%, the way they structured the portfolio, he may have to come back and revise it to increase it so that more pension funds will go and invest in the bonds market and for long-term infrastructure. So that is where government may have to be able to raise the funds. So these are some of the measures of my head. I mean, the minister must be thinking of to make sure that he gets new funds coming in, and then also possibly talk to external investors to tell them, now we have stability. Can you put some money in our financial sector, which is our local investment? And then we assure them that when the time comes for them to probably to invest, then we'll be able to send them their money. So instead of going for Euro bonds, we may have to do a roadshow outside and ask these entities to now come to Ghana to invest in our local market. So these are some of the things that needs to be done to be able to get the funds.
But overall, do you think the 2026 budget is leading us to the path of sustainable economic transformation, or are there risks that could undermine the government's plans?
So transformation, if you ask me, we made his focus on primary balance of 1.5 is one angle of transformation, focusing on being disciplined. But in terms of creating employment, which is one leg of his teams, is going to be difficult because of his financing option, crowding out the private sector. So I go back and say it again. This budget is it's government engine growth approach and not private sector growth approach. If you listen to him, he was very specific and saying that his budget is intentionally going to create 800,000 jobs. He knows that private sector jobs will be struggling. That is why he was very specific. And these jobs that are going to be created are only tied to the most of the capex activities he's hoping to do. If he fails to raise the funds, then the job creation will not happen. And this is why I'm sounding the warning that his budget is ambitious. He's going to work on a very thin line to make sure that he succeeds. I hope that, and I believe that with his team, they are going to look at the numbers again and see what they really need to do to make sure that the financing gap raising will not affect private sector, to come back to the point where we say private sector is the engine of growth and not government as the engine of growth.
Right. Thank you so much for your perspective, Professor Williams Pepa. Yeah, a few things might.
Thank you very much.
Professor Williams Pepa, Associate Professor of Finance at the Andrews University. I appreciate your time here on The Marketplace. You're watching The Marketplace. You're taking a short break. When we come back, investors are ditching Treasury bills after the 2026 budget presentation. We'll find out why. And welcome back to the marketplace. A time for your financial market updates. And investors continue to ditch the Treasury market despite the Finance Minister, Dr. Kansela Tuforsen, unveiling the 2026 budget. According to the Bank of Ghana's auction results, the government failed to meet its target yet again. Meanwhile, interest rates continue to surge on the yield curve. Joining me on Zoom is McJordan Sika-Nate, who is Senior Research Analyst at Laurus Africa Securities. Hello there. So, McJordan, despite the Finance Minister's 2026 budget presentation, investors are still fleeing the Treasury market. What does this tell us about the market confidence in government fiscal policy right now?
Good afternoon, Darryl, and thanks for having me. So like you mentioned, we had the budgets last week, but despite government's commitment to fiscal discipline, we've still seen underperformance in Treasury bill auction. I mean, not too surprising to me because really that's just one leg of it. Government's commitment to fiscal discipline is one leg of investor confidence. Because really, when you check after government confidence and credibility, aside that, a rational investor will be also looking at what their returns is. And currently, as it stands, the returns on the Treasury bill side is not competitive. Because in terms of government fiscal operations, I mean, the numbers are clear. Yet, as of 9 months, we have overall deficit at 2.3, and then the projected one for going into 2026 is at 2.2% of GDP. So really, in terms of government fiscals, the market is welcoming of it, but then I think the issue still remains on the return side. Yeah.
And so, just for the sake of our audience, just give us an idea how the auction went on Friday.
Okay, so on Friday, we had investors pushing through over 3.9 billion. Government's target was 6 billion. However, the government was able to reject some of the bids and accepted 3.83 billion Ghana cedis. It had to do that at a cost where we saw an increase in yields. We saw the 91-day yield, show up about 10% to 11.3, and that's like the highest in about 17 weeks so far. Similar trend was seen on the 182-day yield, and the 364-day yield was up by about 6 basis points last week.
Yeah, and you say what we saw on Friday may not be a direct reaction to the 2026 budget?
Yes, because like I mentioned earlier, in addition to government credibility and its fiscal discipline, there's another leg to confidence, and that's also returns, right? At the moment, when you check the play on the markets, I think the government treasury bills present, really lower returns compared to other competitive securities on the market. And for instance, let me give a clear example. We had liquidity on the market last week. The BOG was able to raise close to about 17 billion in its automobiles, and that was around about 21.5% interest rate. So when you compare this to where government treasury bills are currently with the 91 benchmark around just 11%, you could see that wide difference. You are talking about over 1,000 basis points. And for an irrational investor, yes, you could have the credibility, but if the BOG securities also, gives that balance in terms of risks and return, then they will go for that. So that was the play on the market last week.
And McJordan, interest rates continue to surge along the yield curve. Based on your analysis, what is driving these yields? Is it purely market perception, liquidity pressures, or something deeper in the macro environment?
I think my earlier submissions clearly point out that, I mean, from where we sit, we don't have, we don't think these point to deeper macro fundamentals, because clearly the numbers point to an improving macro fundamentals. So really, we are talking about year-end shift on the market, which is also affecting liquidity, and also the fact that you currently have, very juicy rates, a juicy alternative to the Treasury bill side. I think I'll extend further on the liquidity side. So we are currently heading into a season and the year-end dynamics where you see more spending activity from businesses and households towards the festive season. So really for most of these financial intermediaries, it's been a good time to also, have ample cash reserve to meet, withdrawals and the likes. And so really around these times, you see, a slowdown in liquidity on the market. But also on the other end of it, even though we've seen inflation on a decline, you still have OMO rate high, in a double-digit terrain. And that is really, affecting the government's ability to attract significant bids in its auctions. Yeah.
Okay. And so what does it mean that the government has missed its target once again? I mean, how worrying is this trend as we head into a new year?
Yes, I think it is. You could look at it from multiple perspectives. So one, in terms of government strategy, for some investors, it could be welcoming because then the rate at which government, accumulates its debt is gradually on a low. And let me put this into perspective. Now, from start of year January to date, if you compare the number of auctions we've had and the underperformance. If you combine, you'll be looking at some 13 billion in missed targets. Now, assuming these targets were met, and these amounts were going to, be added to our existing debt, and that could also increase our debt profile. So if you really see, and if you even listen to the minister's speech during the budget, you see him hinting at the fact that we've been able to considerably slow down at the rate at which we pile up our debt. And part of it is coming from the Treasury bill side and also the fact that the currency has appreciated and then our external debt portfolio has declined. So you could look at it from that perspective, but also from another perspective, or the market perspective, where if you are missing your auctions, then it becomes worrying. Where then are you going to get funds to, service your debt and also perform other fiscal duties? So really, that's where the worry and concern is. Going into next year.
Quick stock market update. What are we watching this week?
Well, we saw a rebound in the market. This week, we have our eyes on two counters. That's MTN and Bensoil Palm Plantation. We've seen a renewed round of investor demand on these two securities. For Bensoil Palm Plantation, we saw record-breaking interim dividend announcements over 1 CD per share, and that's really driving demand for the stock. We expect some gains this week, and similar for MTN. After going through some dips, we've seen a rebound, and we believe that's positive for the market this week. Yeah.
All right. Mark Jordan Sikanate, Senior Research Analyst, Loris Africa Securities, thank you so much for the updates. We appreciate it. Well, to one of our top stories this afternoon, fuel prices are set to go up marginally at the pumps today. This is as a result of setbacks on the international market. My colleague George Yafe has been going through the industry numbers and reports.
The expected hike in fuel prices at the pumps has been influenced by a sharp increase in prices of crude oil on the international market. This has gone a long way to influence prices of finished petroleum products that are imported into the country. The development could result in the price of petrol and LPG going up by more than 3% per litre and kilogram, whilst diesel could be increased by almost 4% per litre. However, prices could have gone up higher than what has been projected if it hadn't been the cedi's appreciation against the dollar over the past 2 weeks. However, some oil marketing companies have told Joy Business that they will not rush to increase prices from today, as they will still want to monitor market developments before responding.
All right, we've got our eyes on fuel prices for you. More news on our website, myjoyonline.com/business. More on our conversation this afternoon with Professor Pepra. Deeper fiscal challenge faces economy despite budget of optimism. Professor Pepra there. You can read more about that on myjoyonline.com. Also, smugglers now control Ghana's rice and sugar market. Importers blame government inaction. myjoyonline.com/business. Head there for today's latest stories. We will be back same time tomorrow.